2020 to 2021, the current ratio for MyLugs increased from 2.67 times in 2020 to 2.86 times in 2021, indicating a slight improvement in liquidity. This suggests that the company became more capable of covering its short-term liability during this period. 2021 to 2022, the current ratio rose from 2.86 times in 2021 to 3.33 times in 2022, showing a moderate increase in liquidity. This reflects a stronger financial position in managing short-term obligations. From 2022 to 2023, MyLugs' current ratio increased again from 3.33 times in 2022 to 3.58 times in 2023, suggesting a continued but smaller improvement in the company's ability to settle its short-term debts. From 2023 to 2024, from 3.58 times in 2023 to 4.85 times in 2024, the current ratio saw a significant jump, indicating a strong improvement in liquidity. This marks MyLugs' highest short-term financial strength in the 5-year-old period. (2020 to 2021), the current ratio for Panasonic increased from 1.33 in 2020 to 1.38 in 2021, indicating a slight improvement in the company's ability to meet its short-term liability using current assets. 2021 to 2020, the current ratio rose from 1.38 times in 2021 to 1.42 times in 2022, showing a continued increase reflecting a steady achievement in the liquidity position. From 2020 to 2023, Panasonic current ratio increased again from 1.42 times in 2020 to 1.47 times in 2023, suggesting that Panasonic was strengthening its short-term financial health. From 2023 to 2024, the current ratio improved further from 1.47 times in 2023 to 1.52 times in 2024, indicating an even stronger position to cover its current liability with available assets.
Now let's look at the vertical analysis of current ratio. Examining the current ratio, MyLugs maintain consistently excellent short-term liquidity, peaking at a robust 4.85 times in 2024, showcasing a strong ability to meet immediate obligations, whereas Panasonic consistently lagged behind, achieving its lowest current ratio of 1.23 times in 2020, always indicating a relatively tighter liquidity position and also weaker capacity to cover its short-term debts compared to MyLugs.
(2020 to 2021), the quick ratio for MyLugs improved from 1.63 times in 2020 to 1.71 times in 2021, indicating a slight increase in liquidity. This suggests a stronger ability to cover short-term liabilities. 2021 to 2022, the quick ratio for MyLugs increased from 1.71 times in 2021 to 2.01 times in 2022. This suggests an improvement in the company's ability to meet its short-term obligations. From 2022 to 2023, the quiet ratio for MyLugs rose from 2.01 times in 2022 to 2.29 times in 2023, indicating a further increase in liquidity. This change suggests the company continued to strengthen its short-term financial position. From 2022 to 2024, the quiet ratio for MyLugs surged from 2.29 times in 2023 to 3.57 times in 2024, reflecting a significant improvement in its ability to cover short-term liabilities. (2020 to 2021), the quick ratio for Panasonic declined from 0.88 times in 2020 to 0.78 times in 2021, reflecting a weakened ability to meet immediate obligation excluding inventory. 2021 to 2022, the quick ratio for Panasonic decreased again from 0.78 times in 2021 to 0.74 times in 2022, indicating reduced liquidity and greater dependence on less liquid current assets. 2022 to 2023, there was a minor improvement, with quick ratio increasing slightly from 0.74 times in 2022 to 0.75 times in 2023, suggesting a stabilizing liquidity position. 2023 to 2024, the quick ratio for Panasonic saw a significant rise from 0.75 times in 2023 to 0.94 times in 2024, indicating stronger liquid assets management and improvement readiness to settle short-term debts.
Next, for quick ratio, Milex consistently exhibited superior immediate liquidity, where reaching its highest point of 3.57 times in 2024, confirming a very strong ability to cover short-term liabilities without relying on inventory. For Panasonic, conversely showed a much weaker liquidity position, where hitting its lowest at 0.74 times in 2022, signifying a persistent dependence on inventory or less liquid asset to meet its immediate financial commitments.
For efficiency ratio, we use inventory turnover and total asset turnover. For inventory turnover, the formula is cost of goods sold divide inventory. In 2020, we got 3.24 times, but in 2021, we got 2.09 times. For 2022, we got 1.96 times, and for 2023, we got 2.09 times. And lastly, for 2024, we got 3.17 times. Next, for horizontal analysis, the amount of inventory turnover in 2020, which is 3.24 times, is more efficient in managing inventory than better than inventory turnover in 2021, which is 2.09 times. Next, the amount of inventory turnover in 2021 is less efficient in managing inventory and worse than inventory turnover in 2022, which is 1.96 times. Next, the amount of inventory turnover in 2022 is less efficient in managing inventory and worse than inventory turnover in 2023, which is 2.06 times. And last, the amount of inventory turnover in 2023 is less efficient in managing inventory and worse than inventory turnover in 2024. For inventory turnover, the formula is cost of goods sold divide inventory. In 2020, we got 5.24 times. For 2021, we got 3.96 times. For 2022, we got 2.74 times. For 2023, we got 2.78 times. For 2024, we got 4.43 times. Next, for the horizontal analysis, first, the amount of inventory turnover in 2020 is more efficient in managing inventory and better than inventory turnover in 2021. Next, the amount of inventory turnover in 2021 is more efficient in managing inventory and better than inventory turnover in 2022. The amount of inventory in 2022 is less efficient in managing inventory and worse than inventory turnover in 2023. Last, the amount of inventory turnover in 2023 also less efficient in managing inventory and worse than inventory turnover in 2024.
Focusing on inventory turnover, Panasonic generally demonstrated more efficient management in converting the inventory to sales achieving its highest turnover of 5.24 times in 2020 and also consistently outperforming Milux. Milux, while showing some improvement and reaching 3.24 times in 2020, generally had lower turnover rates, which is indicating a comparatively slower movement of inventory, though Pansonic's higher turnover did not always translate into a better overall profitability.
Next is total asset turnover. The formula of total asset turnover is net sale divide total asset. For 2020, we got 1.34 times. For 2021, we got 1.01 times. For 2022, we got 0.91 times. For 2023, we got 0.84 times. And last, for 2024, we got 0.98 times. For the horizontal analysis, the amount of total asset turnover in 2020 is more efficient in using all of its assets better than total asset turnover in 2021. Next, the amount of total asset turnover in 2021 is more efficient in using all of its assets better than total asset turnover in 2022. The amount of total asset turnover in 2022 is more efficient in using all of its assets better than total asset turnover in 2023. Lastly, the amount of total asset turnover in 2023 is less efficient in using all of its assets, worse than the total asset turnover in 2024. Next, we use total asset inventory. The formula of total asset inventory is net sale divide total asset. In 2020, we got 1.08 times. In 2021, we got 1.21 times. For 2022, we got 1.03 times. For 2023, we got 1.00 times. And last, for 2024, we got 1.14 times. Next, for horizontal analysis, the amount of total asset turnover in 2020 is less efficient in managing inventory and worse than total asset turnover in 2021. Next, the amount of total asset turnover in 2021 is more efficient in managing inventory and better than total asset turnover in 2022. Next, the amount of total asset turnover in 2022 is more efficient in managing inventory and better than total asset turnover in 2023. Lastly, the amount of total asset turnover in 2023 also less efficient in managing inventory and worse than total asset turnover in 2024.
For vertical analysis for total asset turnover, looking at the asset turnover from 2020 to 2024, Panasonic generally demonstrated a superior efficiency in utilizing its asset to generate sales, which achieving its highest total asset turnover of 5.24 times in 2020, which significantly outperforming Milux lowest of 0.84 times in 2023. Panasonic consistently showed a stronger ability to convert its total asset into revenue, while Milux, despite some fluctuations and reaching a high of 1.34 times in 2020, often lagged behind, which indicates less effective asset utilization for sales generation.
Now let's move on to the net profit margin of Milux Corporation Berhad. In the year 2020 to 2021, net profit margin increased from 6.91% to 8.76%, indicating an improved efficiency in managing inventory. Meanwhile, in the year 2021 to 2022, net profit margin decreased from 8.76% to 5.26%, suggesting a decline in profitability relative to sales. In the year 2020 to 2023, net profit margin significantly increased from 5.26% to 10.58%, reflecting better management of costs and higher profitability. Lastly, in the year 2023 to 2024, net profit margin decreased from 10.58% to 4.92%, showing a drop in profitability compared to the previous year. Let's continue on net profit margin of Panasonic Holding Berhad. In the year 2020 to 2021, net profit margin increased from 0.91% to 4.56%, reflecting improved profitability. Meanwhile, in the year 2021 to 2022, net profit margin decreased slightly from 4.56% to 4.02%, indicating a minor decline in profitability. In the year 2022 to 2023, net profit margin returned negative 1.46%, suggesting significant operational losses. Lastly, in the year 2023 to 2024, net profit margin worsened further to negative 4.40%, indicating a deeper financial.
Vertical analysis for net profit margin. Milads generally exhibited the superior profitability, achieving its highest margin of 10.58% in 2023, reflecting a strong effectiveness in converting sales into net income. Panasonic, on the other hand, faced significant profitability challenges, recording its lowest and also notably negative margins of negative 4.49% in 2024 and negative 1.48% in 2023, indicating a deep financial loss in those 3 years and a persistent struggle to generate profit from its revenue.
Next, return on asset of Milads Corporation Berhad. In the year 2020 to 2021, return on asset decreased slightly from 9.27% to 8.85%, indicating a minor decline in asset utilization. In 2021 to 2022, return on asset dropped significantly from 8.85% to 4.81%, suggesting post-asset management. In the year 2022 to 2023, return on asset improved from 4.81% to 8.94%, showing a better asset utilization and profitability. Lastly, in the year 2023 to 2024, return on asset decreased again from 8.94% to 4.82%, indicating a decline in efficiency. Next, return on asset of Panasonic. In the year 2020 to 2021, return on asset increased dramatically from 0.99% to 5.50%, indicating significant improvement in asset utilization. In the year 2021 to 2022, return on asset declined moderately from 5.50% to 4.14%, showing a slight decrease in efficiency. Meanwhile, in the year 2022 to 2023, return on asset turned negative 1.46%, signaling poor asset management and operational losses. Lastly, in the year 2023 to 2024, return on asset worsened further to negative 5.03%, indicating a continued financial distress.
Next, for return on asset, Milads consistently show a much stronger ability to generate earnings from its asset, peaking at an impressive 9.27 times in 2020. Conversely, Panasonic struggled significantly in this area, which record its lowest and negative return on asset of negative 5.03 times in 2024, consistently indicating less efficient asset management for income generation and severe losses in later years, especially when compared to Mylat's consistent positive returns.
The ratio for Mylat Corporation Berhad in 2020 is 32.5%. In 2021 is 31.9%. In 2022 is 29.8%. In 2023 and 2024 is 27% and 19.2%. For horizontal analysis in 2020, 1.25% Mylat had a lower risk of debt and was better than 2021, which is 3.46%. In 2021, 3.46% Mylat had a lower risk of debt and was better compared to 2022, which is 4.68%. In 2022, 4.68% Mylat had a highest risk of debt and was worse compared to 2023, which is 2.96%. In 2023, Mylat had a higher risk of debt and was worse compared to 2024, which is 0.49%. The ratio for Panasonic Holding Berhad in 2020 is 36.22%. In 2021 is 29.16%. In 2022 is 35.72%. In 2023 is 30.23%. In 23.37% for 2024. For horizontal analysis, Panasonic debt ratio in 2020 was higher at 36.32% and declined to 29.16% in 2021, suggesting a reduced reliance on external financing. The risk of ratio in 2022 to 35.72 from 26.16% in 2021, indicating an increase in debt usage. From 2022 to 2023, the debt ratio dropped from 35.72% to 30.23%, showing better control over liabilities. Panasonic debt ratio continued to decrease in 2024 to 23 to 37% from 30.23 in 2023, reflecting stronger financial stability.
Next, for debt ratio, which indicate financial risk, Mylat consistently maintained a healthier and more stable financial position, reaching its lowest debt ratio of 19.2% in 2024. In stark contrast, Panasonic consistently carried a higher proportion of debt, peaking at 36.32% in 2020, consistently signifying greater financial leverage and a higher inherent risk compared to Mylat, which prudently reduced its reliance on borrowed funds over the period.
Debt to equity ratio for Mylat Corporation Berhad in 2020 is 1.25%. In 2021, 3.46%. In 2022 is 4.68%. And in 2023 and 2024 is 2.96% and 0.49%. For horizontal analysis, the debt to equity ratio dropped from 35.19% in 2020 to 27.95% in 2021, showing reduced dependence on debt relative to shareholder equity. In 2022, the ratio further decreased to 20.18% from 27.95% in 2021, indicating better capital structure. From 2022 to 2023, Panasonic saw a decline in the ratio from 2022.18% to 17.82%, Reflecting less financial risk, the downward trend persists in 2034 with the ratio falling from 17.82% to 15.74%, highlighting increased equity financing strength. Debt to equity ratio for Panasonic Holding Berhad in 2020 is 35.19%. In 2021 is 27.95%. In 2032 is 22.18%. In 2033 is 17.82%. In 15.74% for 2024. For horizontal analysis, the debt to equity ratio dropped from 35.19% in 2020 to 27.95% in 2021, showing reduced depend on debt relative to shareholder equity. In 2032, the ratio further decreased to 2022.18 from 27.95% in 2021, indicating better capital structure. From 2022 to 2023, Panasonic saw a decrease in the ratio from 2022.18% to 17.82%, reflecting less financial risk. In 2024, with the ratio dropped from 17.82% to 15.74%, highlighting increased equity in financing strength.
Next, the vertical analysis for debt to equity ratio. Milux consistently demonstrated a significantly stronger and more stable capital structure, which achieving its lowest ratio of 0.49% in 2024, reflecting a minimal reliance on external debt compared to owner's equity. Panasonic, in contrast, consistently maintained a much higher ratio, reaching at its peak 34.19% in 2020, indicating a comparatively riskier financial structure and heavily reliant on long-term borrowings.